guys doing well this evening? My name is Graham Heath, and I am a founder and the CFO of a company called I3E Energy, as you may have surmised. This will all be inside of your presentations that you receive later, so I will save you the read through. Just some quick highlights about the company. So I3E it's named that as it's my partner and my third time doing this collectively. That would be starting a North Sea operating company. So we are based in Aberdeen. That's where our whole technical team is. I spend most of my time down here because I'm in the finance side, but rest assured we have another dozen individuals, a highly technical complement of staff up there that is at present focused on two things. One is delivery of a starter pack asset that we have called Liberator. We're bringing that on stream next year, and in addition to that, we're looking on how to grow the company in the near future. So as I said, we third time through started the company back in late 2014, right before you may recall that Brent took a bit of a wobble and kept wobbling, so our timing wasn't the best. Spent most of 2015 looking for assets to buy, and then in early 2016 put in a bid on an asset that we think is fantastic, and we're thrilled to get it because of where capital markets were at and so on. Took most of last year to actually get things funded, but then into this year we've been steamrolling forward with the development and moving that towards being development ready for very early next year. We plan on executing on development in the first half of 2018 and bringing that on production, circa 7,300 BOE per day. From a financing perspective, so we've just recently listed on AIM. There's 26 million shares issued and outstanding, very closely held at present. 65% of the company is management owned. 51% of that is between myself and our CEO, Neill Carson. 82% tightly held, right? So there's a very low float that's out there. We wanted to go ahead and get the company listed so that we can access capital markets when we're ready. Like I always say, you try to get all the ingredients into the pan before you put it in the oven to bake the cake, and getting listed on AIM was one of those for us. Pass on strategy. Just quickly on the founders and the board. Like I said, myself and Neill, this is our third time doing this. Neill grew up in the North Sea, spent the first 17 years of his career at Amoco BP, worked in a bunch of basins around the world, Bolivia, the Netherlands, Pakistan. Came back and started a company called Ithaca Energy in 2004. That may ring a bell from recent news. They were bought by a company called Delek just recently, earlier in this year, for north of $1 billion. They were and are still developing a lot of the assets that Neill put into that portfolio. Neill and I have been working together for 7 years now. That's what I looked like when I met him. Well, I'm very fond of that picture. I kept it there for a long time. Anyway, we met when we started a company called I3E Energy. We grew that up to about 42 million barrels of 2P reserves and about 60 million barrels of contingent resources. Our peak was just below 6,800 barrels a day of production. After Neill and I left to start I3E, like I said, it was right at the very start of the downturn, and that company unfortunately had its key producing asset, which was called Huntington. It was supposed to have about a 6-week shut-in. Turned it into a 6-month shut-in, and across that time period, Brent went down by 50%. And unfortunately, it was one of the companies that didn't make it through that last downturn. Chairman of the board is a gentleman named David Knox. He and Neill used to run BP Pakistan together. David went on to run BP in Australia, and then went and joined as the CEO of a company called Santos, a really big LNG company in Australia. Ran that from 2008 to 15. He has recently retired from the corporate world. He's probably busier than he's ever been right now with other board positions and so on. Majid Shafiq, you may have seen him around the city at points in time. He is the CEO of a London arm of a Nigerian bank called Argentil, but he used to be the managing director for First Energy, which is a specialist oil-focused investment bank here in the city. So we're thrilled to have him. Obviously, get tons of M&A, A&D, financing, funding history from him. And then Richard Ames as well. Grew up as a geologist at Amoco. Spent early part of his career actually looking at a lot of fields in the North Sea Basin. Ended up going through the corporate side of the company. Worked for BP when he was at TNK BP in Moscow. He was a VP there who was focused on really government liaisoning and business development and exploration management. So the field itself, our first asset is called Liberator, and it's in a world-class fairway. It was discovered by a company called Dana Petroleum, quite recently actually, back in 2013. An important point there is the individual who chose the well location for that is a gentleman named Mihai Butak, and he is actually now I3E's manager of new ventures. So he joined us in early 2016, prior to us actually going and acquiring this asset. So when Dana made their discovery in late 2013, they'd said that they had found, say 10 to 15 million barrels. I think Brent at the time was $107, and there was a, press out about it that it may be, north of $1 billion or billion pounds valuation at the time. So we have always been interested in the area. The Captain Sands Fairway, which is this big yellow stripe through the North Sea that you see up there, it's extremely prolific. It contains extremely prolific fields. There's the Captain sort of heavy oil in the far northwest, and then it runs a few hundred kilometers all the way down to a field called Britannia, which is a gas condensate field. Liberator is right across the street, as it were, from a field called Blake. It's owned by Repsol and Idemitsu. The Blake and Ross fields, which sort of anchor around Liberator, have been producing since 1999 and 2001, respectively. They've produced at world-class levels. We're talking 60% recovery factors, which is fantastic. The Blake infrastructure that's in place will be our offtake for Liberator. So, some of the things that we looked at when we were looking for assets were to make sure that they are material in size for a company of our size, to make sure that they are highly deliverable, to make sure that they are in high-quality reservoirs, and basically could be developed at low cost across infrastructure that really wants your production, right? Because otherwise you can get stranded, right? So the Liberator field is going to be basically developed from the Blake infrastructure that's currently there and is in production today. As you can see, so we had our reserves done by a company called Gaffney Klein and Associates. They're our reserve auditor. They currently give the Liberator field cluster about 16 million barrels of 2C, so contingent resources. That's basically contingent on us getting field development plan approval. We have reworked optimized our well positioning and plan so that we get, much of that 16 million barrels is coming off our own block at present. What you'll see is the LLA there, which is the Liberator license area. That's what we physically own today. And then this area in green up there, which is the Liberator field cluster. And that's what contains the 16 million barrels at present. Approximately 11 million of that is on block. But as I said, in optimizing our well locations, we expect to get close to that 16 million barrel level available to us on block. How many people here are subsurface geoscientists? No hands. Okay. Oh, there's a couple. Okay, so the important points on this slide are a couple things. So one is, like I said, Blake has produced at 60% recovery factors, so fantastic recovery factors. By end of life, it's probably going to produce about 73% of what they originally submitted in their field development plan. We expect Liberator to get more towards that. From what Gaffney Klein say today is that we'll end up having a recovery factor of about 31%. So there's some upside in that alone. Liberator shares the exact same oil-water contact as the Blake field next door. So when they drilled the discovery well, they found that oil-water contact at 5,270 feet. Beyond that then, through the testing that they did, what they found is the oil itself is 30.3 degree API oil, 1.9 centipoise of viscosity. So to people who are non-technical like myself, what that means is basically it flows, it's very liquid. It flows really well. And then the reservoir itself is sort of a 2 to 3 Darcy reservoir with 29% porosity. So that means that you've got a reservoir where the sands you can almost blow through. So it means you've got, a highly liquid oil that can move very easily through the sand. So that's what drives these high recovery rates, in addition to the fact that there's a really huge aquifer that runs under that entire Captain Sands fairway. And as you begin to pull oil out of the reservoir, that acts like a piston, right? So you get these really high returns. Development ready project. So Liberator itself, it's hard talking through a set of slides where we as a company and the project has moved onward since, and that's the case. This is sort of from when we listed a number of months back. We have submitted our field development plan, right, to the Oil and Gas Authority. So that's it's an iterative process, but they've gone through. They've had their technical team to meet with us in Aberdeen. So we believe that the field development plan is endorsed in its current form, which is good. We are deep in conversation with the owners of the Blake infrastructure, right? So that's where our production will be going. So you negotiate its offtake terms. So we're going through the technical studies and so on with them at present. And we expect to get both of those elements largely wrapped up by year end. The other key element, of course, then is working with the supply chain to make sure that we can access all critical, kit, equipment, services, and so on the timeline that we're trying to get the project delivered on. And there is nothing at present that has gone unsourced as far as the project timeline requires. So like I said, we'll be out in the field very early into next year, actually in the operational forum. We've been out just recently we did a site survey on site, and we basically assayed the two well locations where the first two wells will go. It's very simple development. So basically, there's 6 wells that have been drilled up into Blake. Each of those wells has produced about 15 million barrels across their life. We really see the first Liberator well as a look-alike, just in a southerly direction. So lots of familiarity, lots of production history, and we're using guys who drilled those original wells, right? Like I said, it's quite simple because the oil-water contact is known. We're drilling on depth, right? So basically we know that when we get down about 40 feet above that 50 to 70 oil-water contact, then we've just got to stay basically on plane, right? There's something called look-ahead technology now at the drill bit, right? So it can see about 200 feet in every direction. So you see both where the top of the reservoir is and also the oil-water contact as you drill, right? This is my favorite slide. I'm just kidding. It's absolutely terrible. So this is like I said before. So we've got some of our resources are on block and some is off block. And then the infrastructure that it produces across is it's this floating production system. A few slides back, you will have seen a boat called the Blowholm. And right now, the insurance certificate on that Blowholm exists out to 2024. So when our reserve auditor looks at our ability to recover resources, it has to put all of these different sort of forms of stipulation around it. The key points, I guess, to point out are that on the best case basis, there's a stock tank oil initially in place of 51 million barrels. All right. What they do now is they go and they take a recovery factor and they apply that against that 51 million. So 31.2% is what those end up averaging to on a volume weighted basis. And 31.2 is, that would be a great asset in the North Sea, right? Would produce at 31.2%. But like I said, we expect to produce more like Blake next door. So maybe not at 60% because the ceiling height on their reservoir is taller than ours. But we expect to see between 40 and 50. So there should be some upside from there. So if you take that 31% and you apply it to the 51.4 and you add together the two, so an on block and an off block number, that's how you get to our 16 million barrels. So that all translates though into what you're probably most interested in, which is the economics. And the Liberator development, so I said before it's low cost. There's a couple of things in the North Sea. One is it's infamous for extremely high costs, and it's infamous for really bad weather, right? So what we're looking for is a simple development where even if you were drilling in the winter months, it wouldn't be too big of an issue. And we're also looking for something that's very low cost. So with the I'll try and point to that from here actually. So this here is going to be the manifold, and we're basically drilling this well that goes down there into Liberator. Okay, that's about 150 meter tieback to producing infrastructure that's already there. So normally what you'd see is you'd see a satellite field that's 10 or 15 kilometers away from a big piece of infrastructure, and you'd run a really long tieback to that. Well, that's not the case here. This is basically a low-cost drilling program where you're doing a very short tie-in then to infrastructure that's already producing. So it means that the development itself only takes, say 90 days round trip to actually get on production, which is great. It also means then that it's basically just a drilling program. So these numbers that you see 41 million for the cost of the development itself. Those have come down largely because a lot of the quoting that was going on, these numbers are from early 2016. Rig prices specifically have come down since then, about $90,000 a day. These numbers are based on $150,000 a day for a rig rate. Just to put things in perspective, back in 2014, we were looking at rigs that were $400,000 a day. So, the benefit, I guess, of being in the environment that we're in from a commodities perspective is that we can actually access kit and equipment at reasonable prices. From a daily run rate basis, we're currently in negotiations with the offtake infrastructure owners on the tariff, but these are numbers that we expect, and they're sort of industry benchmarked for what we could expect, and it equates to circa $8 a barrel of liquids produced. So from a production perspective, what it shows you basically is across 2017 into 2018, we expect to have 6,200 BOE per day. That's inclusive of 85% uptime at the blowhole. And then a second well coming on in 2020, right? So that's if we stage the two wells, that's sort of what the profile looks like. What we're working with the supply chain to do through sort of vendor financing is to actually bring those two wells back to back, right? So you would end up moving much of that production curve there in 2020 over to the left, and that would come on in 2018. From a cash flow perspective, the important points to point out, I guess, is even with this production profile, you can see that we're producing $300 million of cash flow across the first 3 years of production life. The trick for us as oil and gas guys then is to fill this empty corner. That's what we are working on with concerted effort at present. There's something called the 30th offshore license round right now in the UK, and we are bidding to win on assets that we believe will be very material to a company such as ours. I won't drag you through this too much. Basically, it's just like a project level income statement for Liberator based on Gaffney Klein and Associates numbers. The important points is for the 10 million barrels that get produced between now and 2024, it has a pre-tax NPV10 of 311. You can see that we obviously pay a lot of tax. It's about a 40% tax rate in the North Sea. One of the tricks for us is to work out how to shield that tax. So there's lots of tax pools that are readily available in other entities in the North Sea. So it makes sense at some point in time that we would either buy assets from them that carry reasonable tax pools, or potentially merge, or it makes sense. There's companies with $1 and $2 and $3 billion of tax pools where it makes sense to have a high cash flowing company or asset such as this sort of tacked onto their underpan. Sensitivities, we like to stress test everything. Basically what we do is we add and subtract 35% to all of these things above, which are already heavily contingencyed, and even in this low case, so obviously the two most important things with any oil field are how much you produce and how much you get paid for it. So with a 35% decrease in the Brent deck that we're using, that would represent life of field, so between now and 2024, of about $43 a barrel. So you can see even under those conditions, it's still a very robust project. On a 1C basis, so our low production case and our low recovery case, we've got a net present value 10 break even of $23 Brent. So we could be substantially lower than where we are today. and still breaking even from a project perspective. So I could run you all through this again, but it's basically a summary. Catalyst rich. So the things for us that are presently at focus is deliver Liberator, 7,300 barrels a day in 2018. Grow our portfolio base. So like I said, we are looking at, it's going to be a great problem to have when we have to redeploy a lot of the cash that's going to be spun out of Liberator, and we're looking for assets that are of a similar DNA and a similar ilk with which we can re-inject that cash flow into. We've got the team to do it, and they are, like I said, highly delivery focused, and also guys who've been around the basin for their entire careers. So we've got a small targeted list of assets that we're looking at that we plan on going after aggressively, and some of those are in that 30th license round. And we're in an environment that we think is beneficial for that. The Oil and Gas Authority has come up with something called MER UK. It's maximizing economic recovery in the UK, and they're supporting companies such as ours to get these things done. You've got majors leaving the basin, and you need companies such as ours coming in and doing some of these smaller projects to do a large mop-up exercise eventually, in place of the companies who aren't interested in doing that at present. So that's the story. I guess we're on to questions.
Lovely. Thank you very much indeed.
Thank you.
Look at that. Spontaneous.
Got to wake
applause.
everybody up.
There we are. Do you have any questions, please? Any hands? Gentlemen here, please.
Hi,
Hi.
my name's Michael Adams. That was a very interesting presentation. Can I ask you this? Have you completed your AIM listing requirements?
Yes. So sorry that I didn't go into that in more depth. We are listed on AIM, right? So our symbol is I3E. Like I said before, basically what we ended up doing was an introduction to AIM. So we had done a pre-IPO where the investors that came into the company alongside us as a board management team who also invested to buy the asset initially. We basically decided to convert some of our shares and then float those onto AIM. We haven't done a large-scale financing as yet on the AIM market, a secondary issuance. At present, obviously, if we've raised $8 million and there's a $40 million development, we're at a shortfall, but we're doing what any company does with a great asset. We're looking at every funding avenue right now. So that includes debt. That looks we can look at farming down if there was interested parties, and we thought that was going to be a benefit. So yes, we've completed all of our listing requirements to get onto AIM, and we are listed and trading.
Thank you.
So just to clarify, when you listed, did you raise any money at that point?
We did not. Nope. We did basically a straight introduction to AIM.
Okay. Any more questions, please? Can you tell us a bit more about the environment in the North Sea? You mentioned tax.
Yeah.
And it's something, and I'm no expert. Explain what some licenses have tax pools.
Yes.
Or tax breaks. Others don't. Why and how does that work?
Yeah. So just North Sea in general. Like I said, I think the North Sea is a good place to be going into at present. The oil and gas industry for the UK in general is an important component. We are coming from a very high tax environment. We were 62.5% tax a couple of years back. That's now come down to 40%. So, in the lower commodity environment, the government recognizes that, and they're trying to promote the business. Another way that they do that is they put allowances in place that as you expend capital into the basin, you build up tax pools to make sure that you're shielding future cash flow, right? So given the different regime changes over time, you've got, there's been periods where there was no allowances and no shields, and then you've had other periods where there's much larger allowances and shields. Well, we're in one today where for every dollar you spend, you get to shield about 62.5% of that dollar, right, in your future cash flow. So there's assets, therefore, that have tax pools, others that don't. And there's lots that have, fully, if you drill so you develop a $150 million field, and you end up producing $1 billion of cash flow over time, well, when you hit the $150 million mark, your tax shield was gone. Yeah.
Okay.
Yeah.
So that you can do deals and essentially use that pool that they've already accrued for this Liberator field.
Yeah. So it's not quite as it used to be more straightforward like that. It's not so much anymore. You basically have to be buying assets that are going to be utilizing the tax pools that they created.
Okay.
Right. So
They're not transferable.
they are transferable, but you have to apply for something called group relief. So basically, you bring the assets in, and then you show why it makes sense that the tax pool is in alignment with the rest of the assets that you have in your own portfolio.
Okay.
Yeah.
One more question for me, and it's about I think on the final slide, there was something said about 300 small opportunities. That's right. The big boys aren't so interested in, or they're not economic for them. Of those 300, how many would you feel fit the criteria explained earlier on, that they're proximity to infrastructure, all the things that you would look for? Yeah. How many opportunities do you think there are for a company of I3 scale and ambition?
A small handful. There's not. So Liberators are rare, very rare. That's why it's a fantastic asset, really, and everybody who sees it would agree with that. Of those 300 small fields that are available, it's not to say that they're not economic. Very few are as economic as Liberator is. So it makes more sense then that you would go on if you're going to acquire them, you would go towards the larger end of those small pools, because you're likely having to tie them back. It doesn't mean that they're not going to be fantastic producers, right? Because a lot of them are in high quality reservoirs and so on. So, yeah.
Okay.